What up, HyperChange? Welcome to another episode. Today we're talking about Salesforce, ticker is CRM. Shout out to Steve on Twitter requesting this episode. I'll take a moment to give a shout out to everybody. Been getting tons of emails, Twitter messages, all that kind of stuff. Love hearing from you guys. If you have any episode ideas, feedback about the show, let me know. I try and reply. Thanks for all the love. Woo! Anyway, let's get back to CRM. This is a company I've been following for a long time now. They're a really interesting player in the enterprise software space, founded by CEO Mark Benioff in 1999. He's a pioneer of putting software on the cloud. Salesforce's entire thing is that instead of installing these massive custom systems that Oracle or let's say Microsoft or SAP does, they come in with a cloud service, CRM, customer relationship management, which allows you to store your sales, all your contacts, all your leads, all your opportunities. And that's the core value of their platform. Salesforce has been in the news. They just reported their quarterly earnings. They've crossed a $10 billion revenue run rate. This is epic, a huge milestone for the company. Props to them. Shout out to Salesforce. The company has had an incredible growth trajectory. They're growing at 25% to 30% almost nonstop every single year. Their business model is SaaS, software as a service, subscription, recurring. The market loves these type of businesses. Basically, you pay a monthly fee per user of each salesperson or whoever employee you have using Salesforce's software. Customer relationship management, or CRM, the space where Salesforce competes, is the fastest growing part of the enterprise software category, projected to grow at a 14% CAGR for the next 5 or 6 years. This is why the market thinks of Salesforce as such a high growth company. But not only is their entire core market growing, but they're in fact taking market share as well. If you look at this, they're competing with a bunch of legacy players like Oracle, SAP, and Microsoft, who are just not as innovative. They weren't native to the cloud, so they're having a very difficult time adapting to what Salesforce's model. And as you can see, the numbers don't lie. Salesforce has just been consistently eating up market share. I mean, I'm not a Salesforce customer, so I want to just disclaim that. So I feel like I lack excellent insight into the company. I'm not an expert in software as a service businesses, not an expert in enterprise software, but from what I can tell, people love the product. This is a staple of almost every Fortune 500 company. They're building and layering on top value add services onto their platform that just makes it stickier and stickier. This is a really, really good product led by an incredible CEO with an amazing track record of growth and innovation. I think Forbes ranks them as like the most innovative company in the world, ahead of Tesla for almost 2 years in a row. Tremendous respect for what Salesforce has done, but I also have a couple problems with their business model. Now let's dive into the financials and the valuation. Salesforce is currently trading at $94 per share, which is equivalent to a $67 billion market cap. Remember, the company just passed $10 billion in a revenue run rate. Therefore, they're trading at about 6.7 times sales, which is at the higher end of most companies. But remember, this is a recurring software as a service business model the market loves. Think Netflix, TV as a service. The market is always giving these a premium price sales multiple. Additionally, the company's been growing at 25 to 30% for years, as long as I can remember. So that's also the reason why the market's giving them that multiple. Additionally, the company has already set its sights on a $20 billion revenue run rate. Even though they just passed $10 billion, they're setting their sights on $20 billion. The addressable market for customer relationship management is going to continue to explode, and they're going to continue to take away market share. And unless that stops, it looks like a pretty clear path to $20 billion in revenue. How do you value a company like this? If you look at their earnings, they have none. Their revenue growth has been consistent, but they're not profitable at all. But if you look at their cash flow, they're going to tell you that they're always producing billions in positive cash flow. So what's going on here? In their GAAP income statements, they have to account for stock-based compensation as well as the amortization of intangibles from acquisitions. These are non-cash expenses, so that's why they're getting all this cash on their balance sheet, but you're paying for this in other ways. And this is my biggest problem and flaw in Salesforce's model and why I'm not comfortable with the company. If you take a look at the GAAP versus non-GAAP operating margin, there's a huge, consistent, almost 10 to 12% gap there. So what's going on? The bulk of that, almost 80% of those expenses and that gap is stock-based compensation, which I would argue is a real recurring expense. Yet they're not accounting for that. They're basically telling you that it's not an expense, and I don't know why. And just because it's not cash doesn't mean you're not paying for it. If you look at the company's share count, it's increased pretty consistently. And part of this increase is because they're giving out shares to do acquisitions, but the other part of this increase is that they're paying employees a ton of money in stock-based compensation, and they're not really including this expense. So this is why I like to use GAAP income statements and not try and get too fancy, because I think companies are trying to fool you with non-GAAP. And if you look at the GAAP, like, there's just no profit here. And, I've talked about companies like Netflix and Tesla and Amazon that I'm a huge fan of, even though they have no profit. And that's because I understand the business model. I think I understand the levers that they could pull to get to profitability. With Salesforce, I've almost seen a linear acceleration of the stock-based compensation expenses with the revenue, with the company's maturity. So I just don't see the inflection point where these stock-based compensation expenses get reined in and the business model really starts to produce value when you include dilution. To sum it up, great product, but I'm unconvinced in the business model. My guess is they're going to soar past that $20 billion revenue run rate. I think the stock is going to keep killing it. They're going to continue to trade at about a 5 to 6, maybe 7 times price sales multiple. As long as that revenue and top line keeps growing, I think you keep getting a climbing stock price. But on a broader note, I think it signals some concern that I would have among the market. Workday, Splunk, all these enterprise software companies are all using the same model where they don't account for stock-based compensation. I think this is totally messed up. I don't get it. I would love for someone at HyperChange to understand. I just don't see how the business is making money unless you forget that they're actually using stock-based compensation. Benioff, I think, is an awesome CEO. He's big about human rights and equality and building community and love and happiness and positivity. I'm all for that. So I think he's just an awesome CEO. And they've been voted an incredible place to work as a company. These are all great signs for culture, for innovation, for long-term value for shareholders. So there's a ton of positives here, but I fully can't wrap my head around a business model. So I'm not really bullish or bearish, but I think it's a hell of a product and a hell of a company. If you guys have comments, let me know. That's HyperChange. I'll see you guys next time.